So I'm basing this whole forecast on the fact that the Fed is going to be wrong. Economy's not as strong as they think it is. They're going to be cutting more than just the 50 basis points they're expecting. That combined with this ongoing central bank demand and what else is coming at us this year, Elijah, I think makes for a pretty strong year for the precious.
You're watching Silver News Daily. Subscribe for more.
What if I told you that 2025 could be the year gold and silver make history, with prices soaring beyond anything we've seen before? Sounds far-fetched, right? But Craig Hemke, a leading expert in precious metals, says it's not only possible, it's probable. Stay tuned as we unravel why central banks, a faltering dollar, and seismic shifts in global markets could ignite a gold and silver explosion. You don't want to miss this.
See where we go. Keep an eye. One last thing I wanted to mention, and I just didn't seem to work it in. Another headline that was buried back in December was the People's Bank of China coming out and publicly pronouncing that they're going to have a moderately loose monetary policy this year. That the last time they had a moderately loose monetary policy they publicly announced was 2010. Okay, so we know what was happening in 2010 and 11. They then changed it to prudent. And they've publicly been saying prudent for 14 years since. But they said moderately loose. This is a pretty big deal too. We're seeing it already. Just the last 5 days, copper has turned a corner, blasted higher, broken its downtrend from September, moved above its 50-day moving average. This is another thing that's going to influence things too. Chinese markets, yield on the Chinese 10-year is collapsing. They may have bigger problems than that, and they may be trying to get ahead of it. But if that money, they're going to be cranking out, the printer. Here in the U.S., when the Fed turns on the printer, it all flows into stocks and Bitcoin and all this kind of stuff, right? Well, they don't do that so much in China. I mean, there's a lot of speculation in commodities. Remember the big blowout in spreads from the Shanghai Exchange versus the COMEX back in May that just forced the COMEX price higher. But anyway, understand that part about China is an important thing for this year too. We may already be seeing it in copper. Keep an eye on copper as we go through this month, and let's see if that isn't a precursor to a rally in silver. But
in 2024, something extraordinary happened. Central banks around the world purchased nearly 745 metric tons of gold, marking one of the highest levels of annual demand in modern history. Why does this matter? Because this buying spree isn't just a one-off event. It signals a deeper trend that could shape the precious metals market in 2025 and beyond. Let's break this down. Central banks, particularly those in emerging markets like China, Turkey, and India, have been aggressively diversifying their reserves away from the U.S. dollar. Why? Because the dollar's reliability is under threat due to ballooning U.S. deficits and geopolitical instability. This has created a perfect storm for gold, which is seen as a safer, more stable store of value during times of uncertainty. China alone resumed significant gold purchases in late 2024, reportedly acquiring over 15 metric tons in just November and December. And these numbers might only scratch the surface, as unofficial purchases could be 10 times higher than what's disclosed. This steady demand underpins gold prices, acting as a physical floor that prevents the price from dipping too far, even during market corrections. Now, what about silver? While gold often grabs the spotlight, silver is also riding this wave of demand. It serves as both a monetary asset and an industrial metal, giving it a unique edge. Industrial applications, especially in renewable energy technologies, are surging, but more on that in the next step. For now, understand this. Silver, too, is becoming increasingly desirable to central banks as they expand their diversification strategies. The big question is, will this trend continue into 2025? All signs point to yes. With global inflationary pressures, mounting debts, and geopolitical uncertainties, central banks are likely to keep buying gold and silver to hedge against currency devaluation and financial instability. This consistent demand could set the stage for a spectacular year in the precious metals market. Before we move forward, what do you think? Is central bank buying enough to propel gold and silver to new heights? Or are there other factors we should watch for? Drop your thoughts in the comments. And don't forget to subscribe to stay updated on these pivotal market trends.
Yeah, I don't. When I first started out of college, I signed up at Payne Weber and went through the Series 7 training and got my stock. I was a stockbroker. That's how old it is. I actually call myself a stockbroker right now. You're financial account executive or whatever they call it back then. But I was a stockbroker. And you were a stockbroker because you did the homework, right? You'd sit there, you'd pour through value line things, and look up Morningstar reports and in your own sell side research that came out of your firm, and you tried to find stocks that were going to do pretty well. And you convince your clients to buy them. That has all been, now it's all just, ETFs and managed money and wrap fees and passive investing. Well, that has carried over to the mining sector, right? People are, I want to put some money in the mining sector. I don't know anything about the mining sector, so I'm just going to buy the GDX. Well, the problem with that is, as I mentioned, the GDX was only up 8% last year versus gold being up 26%. Why? Because, and it's worse than just these two, but 20% of the GDX is Newmont and Barrick. Newmont was down last year? Down. Barrick was down 15% last year. Their share price. Gold's up 25% and Barrick goes down 15%. Why? Because they can't control their costs. So even as gold price is going up, their costs are going up just as fast. Their margins aren't increasing. And so if you're good, my point is, passive investing is now all the rage. Nobody wants to do their homework and be a stock picker and all that kind of stuff anymore, right? So they just passive invest to get the GDX. GDX underperforms and everybody says, to hell with it. This sector's terrible. Well, it's not really. Agnico Eagle was up 60% or something last year because they do control their costs. Kinross was almost up 100% last year because they do control their costs. So the point I tried to make in this year's Macrocast was not so much, hey, look at this chart at GDX and look at the 50-day moving average. And, if we can just get to this level, there should be some resistance. Phooey. If you're going to be in this sector, again, there are you and I know lots of folks that this is all they dedicate their lives to is looking at the mining sector. And they have a subscription website to tell you what, they know what grams per ton over a length of, drill hole and all that stuff. They know what that stuff means. If you're going to be in this sector, you're going to have to do you can't, even Stan Druckenmiller, Elijah, one of the greatest investors of all time. When headlines show up that Stan Druckenmiller's moving into gold, he buys the GDX and he buys Newmont. What? Come on, Stan. Newmont's the biggest dog in the doghouse. Like I said, it was down last year. So anyway, moral of the story in the mining sector. If you're going to do this, there's profits to be made. And if gold's going to 3,100, AEM's probably going to have another great year. You can do great. And you can get leverage to the gold price, but you're going to have to do some homework. You just can't simply just say, buy me the GDX and see what happens.
One of the most significant factors poised to influence gold and silver prices in 2025 is the Federal Reserve's monetary policy. The Fed has already signaled a potential shift, with plans for 2 rate cuts totaling 50 basis points. But here's the twist. Many experts, including Craig Hemke, believe the Fed is underestimating just how much economic pain is coming. Why does this matter? Let's connect the dots. Lower interest rates make non-yielding assets like gold and silver more attractive to investors. When borrowing costs drop, holding gold and silver as a hedge against inflation becomes a far more appealing option than chasing yields in the bond or equity markets. Now, here's the kicker. The Fed's decision isn't just about managing inflation. It's also about propping up a fragile economy. The U.S. yield curve, which tracks interest rates on short and long-term government bonds, was inverted for nearly 2 years before it finally reverted in late 2024. Historically, this inversion-reversion is a surefire signal of impending recession. Every major U.S. recession since 1980 has followed this exact pattern. If a recession does hit, the Fed may be forced to cut rates much more aggressively than the current 50 basis points on the table. Some analysts predict cuts of up to 150 basis points, or even the revival of quantitative easing to stabilize markets and stimulate growth. If that happens, it could be a game changer for precious metals, driving gold well past its $3,000 target and silver toward $40 or beyond. Here's a real-world example. During the financial crisis of 2008, the Fed slashed rates and rolled out unprecedented quantitative easing measures. The result? Gold skyrocketed from about $800 an ounce at the start of 2008 to over $1,200 by the end of 2009. Silver followed suit, climbing from $11 to nearly $20 per ounce in the same period. So, as we enter 2025, the big question isn't just whether the Fed will cut rates, it's how far they'll go. Will inflation, a weakening economy, and soaring deficits force the Fed's hand sooner than expected? And how might these decisions ripple through the precious metals market? What's your take? Could the Fed's policies push gold and silver to record highs? Let us know in the comments, and make sure to subscribe so you don't miss the next update.
Well, this is a major part of that central bank bid and just general physical demand for gold. Elijah, this came out back in early December. People are already starting to kind of look for Christmas and shut things down. On the 8th or 9th business day of every month, the U.S. Treasury puts out their monthly Treasury statement. So this was back on like December the 9th, right? The U.S. fiscal year begins on October the 1st, ends on September the 30th. So the statement that came out on December the whatever it was, 9th or 10th, was for the month of November and cumulatively the first 2 months of the year. The month of November alone was $366 billion of deficit spending. Yeah. That used to be a national, calamity when it was $366 billion for a year. And now it's a month. For the first 2 months of the fiscal year, $624 billion in deficit spending. So there seems to be, look, I want it fixed too, right? I wish it wasn't like this. But the problem is you can't wish it away, and you can't just wish a fix. And this optimism that somehow this Doge committee with Musk and Ramaswamy, which has no congressional authority, let's say somehow vote to give it some, but I mean, there's no line item veto that the president has. So this optimism that somehow Musk and Vivek are going to trim, $500 billion off the deficit by, cutting out waste, sounds great. But in reality, in practicality, are they really going to do it? Let's just say they're able to cut it by $200 billion or something. One, that's sadly a drop in the bucket. But two, if we get into this economic scenario that I think is coming, well, then economic activity slows, tax receipts fall, and the net difference might be nothing. You might cut spending by $300 billion, but then have your government revenue by tax receipts fall by $300 billion, and you're still running $2 trillion deficit. So you're talking about things that underpin the bid for gold. Okay, that problem is not going away. I mean, it's only, getting worse. What the line item for interest on the national debt last year was 1.1 trillion or something like that. So that, even though it doesn't always make headlines, those numbers are the ones that just remind people that, maybe I ought to divert, like these central banks. These central banks are taking their dollars and buying gold. Maybe I ought to do some of that myself. And that just, again, that keeps the dips being bought, keeps the banks unable to just, smash it backward, $500 to cover some of their shorts. And it keeps moving forward. And the uptrend we always seem to see in the COMEX, 2 steps forward, 1 step back, 2 steps forward, 1 step back. And I suspect that's how it's.
A weakening U.S. dollar and the relentless rise in national deficits, two powerful forces that could supercharge the prices of gold and silver in 2025. Let's break down why these factors are so critical and how they create the perfect environment for a precious metals rally. First, let's talk about the US dollar. In 2024, the dollar showed signs of strength, but as we enter 2025, the tide is turning. The U.S. national debt has now surpassed $37 trillion, up from $34 trillion just a year ago. This massive debt load is eroding confidence in the dollar as the world's reserve currency. Historically, when debt levels become unsustainable, nations often devalue their currency to keep their economies afloat. And this is where gold and silver shine, literally. Gold, in particular, is often seen as a hedge against currency devaluation. When the dollar weakens, gold prices typically rise as investors look for a stable store of value. In fact, analysts expect the dollar to face significant downward pressure throughout 2025, creating a tailwind for precious metals. But the story doesn't end there. The U.S. government's fiscal situation is adding fuel to the fire. Deficit spending has spiraled out of control, with the federal deficit hitting a staggering $624 billion in just the first 2 months of the 2025 fiscal year. To put that in perspective, the monthly deficit in November 2024 alone was $366 billion, more than some countries' entire annual GDP. How does this impact precious metals? It's simple. The more money the government prints to fund its deficit, the weaker the dollar becomes. This dynamic often leads to higher inflation, further increasing demand for gold and silver as safe haven assets. And let's not forget central banks. As global confidence in the dollar wanes, these institutions are accelerating their shift to gold and silver, further propping up prices. The stakes are high. If the U.S. continues on its current fiscal path, some experts believe the dollar could lose as much as 10-15% of its value by the end of 2025. Meanwhile, gold is expected to reach $3,100 or more, and silver could climb past $40. These aren't just speculative numbers. They're backed by historical patterns and current economic trends. Here's something to think about. What would it take for you to trust gold and silver over the dollar as a store of value? Are these metals truly the safe haven assets they're made out to be? Let us know in the comments, and don't forget to subscribe for more insights into the future of precious metals.
That kind of depends on the speed and the severity of the down move in equities. If we get, August the 5th of last year was a Monday, and the markets had been falling, and we got, I think it was mainly based off of Japan and the unwind of the Japanese carry trade. You probably remember that. People listening remember that. And by the time the markets opened on Monday, I think the S&P opened down like 1,000, S&P down 100 some odd points. And in the middle of the night, for us, during London hours, gold fell $100 in like 4 hours because it was one of the few markets that was trading at that time of the day. And if you needed liquidity, there you go. So if you get this really, we start talking, CNBC, crisis in the markets, that kind of stuff, where the Dow's down a couple thousand points a day for 2 or 3 days in a row. Well, then you're getting margin calls, and this liquidity concerns, and everything gets thrown out. If you're a hedge fund and you're levered up in equities, and you've also got a profitable position in 100 contracts of COMEX gold, you need cash. You're selling what you get, what has a bid, maybe what has a gain. You're going to raise that cash to meet your margin call. And that's when everything just plummets. If instead we get in more of a gradual decline, then it's more like people thinking on a regular basis. Well, maybe I should be rolling into gold here because this is showing the economy's going down and the Fed. So it really, anyway, long answer. I'm just back to where I started. It really depends how gold responds, silver too, in a general market pullback of 10 or 20% is going to be a function of how fast that pullback rolls out.
A weakening U.S. dollar and the relentless rise in national deficits. Two powerful forces that could supercharge the prices of gold and silver in 2025. Let's break down why these factors are so critical and how they create the perfect environment for a precious metals rally. First, let's talk about the US dollar. In 2024, the dollar showed signs of strength, but as we enter 2025, the tide is turning. The U.S. national debt has now surpassed $37 trillion, up from $34 trillion just a year ago. This massive debt load is eroding confidence in the dollar as the world's reserve currency. Historically, when debt levels become unsustainable, nations often devalue their currency to keep their economies afloat. And this is where gold and silver shine, literally. Gold, in particular, is often seen as a hedge against currency devaluation. When the dollar weakens, gold prices typically rise as investors look for a stable store of value. In fact, analysts expect the dollar to face significant downward pressure throughout 2025, creating a tailwind for precious metals. But the story doesn't end there. The U.S. government's fiscal situation is adding fuel to the fire. Deficit spending has spiraled out of control, with the federal deficit hitting a staggering $624 billion in just the first 2 months of the 2025 fiscal year. To put that in perspective, the monthly deficit in November 2024 alone was $366 billion, more than some countries' entire annual GDP. How does this impact precious metals? It's simple. The more money a government prints to fund its deficit, the weaker the dollar becomes. This dynamic often leads to higher inflation, further increasing demand for gold and silver as safe haven assets. And let's not forget central banks. As global confidence in the dollar wanes, these institutions are accelerating their shift to gold and silver, further propping up prices. The stakes are high. If the U.S. continues on its current fiscal path, some experts believe the dollar could lose as much as 10-15% its value by the end of 2025. Meanwhile, gold is expected to reach $3,100 or more, and silver could climb past $40. These aren't just speculative numbers. They're backed by historical patterns and current economic trends. Here's something to think about. What would it take for you to trust gold and silver over the dollar as a store of value? Are these metals truly the safe haven assets they're made out to be? Let us know in the comments. And don't forget to subscribe for more insights into the future of precious metals.
Little guy be damned. We're, rising tide floats all boats. So we're just going to cut and QE and do all the stuff we've always done in the past, regardless of what the inflation level is. And so, anyway, this may seem like kind of a rambling answer to your question, but I think other analysts are drawing conclusions from in their own niche area that they observe, but it's kind of in line with what I'm seeing too and other people are seeing. And these things all kind of line up to where I expect later this year. Now, I'm not the next Fed meeting's in 3 weeks. We may get jobs data on Friday that gets everybody all excited. Maybe they'll start cutting again by May or March or something. I don't know. But I'm talking down the line from here. What's it going to look like by summer or fall? What's the Fed going to be doing then? And I'll give you one last thing, Elijah. Do you remember? We've been doing this for so long. Maybe you do, maybe you don't. When I wrote my macrocast for 2019, I called it 2010 plus 9. Well, the idea was that 2019 was going to look a lot like 2010. We began 2010. The Fed was saying, oh, yeah, Bernanke was saying that QE thing was a one-off. We just had to do that. I know we've never done it before, but we had to do that to save the world with the great financial crisis. We're never doing that again. The green shoots of the economy, wherever, all this stuff, right? And then by November of 2010, here came QE too. It was all, maybe we misspoke. Okay. So as 2019 began, it was a lot like this year. The stock market began to tank in 2018. Liquidity was drying up. It was going straight down. At the December FOMC meeting of 2018, the Fed was projecting rate hikes in 2019, and we got into a bind real quick. Well, they quickly shifted tune in the first half of the year, and we were cutting rates. By June, they were forecasting rate hikes. but the first rate cut came in June. So in a way, this could be 2010 plus 9 plus 6 because it's not exactly the same, but it's similar. And so, again, like last year, the market was convinced that there were going to be all these rate cuts and they were wrong. And, all that stuff had to sort itself through as we went through the year. Right now, the market's convinced, there maybe not be a rate cut now till September or June. We'll see about that. It may not turn out exactly as everybody expects. It never does.
History doesn't repeat itself, but it often rhymes. And when it comes to gold and silver, past trends offer invaluable insights into what we might expect in 2025. Let's take a closer look at some key historical moments where economic shifts and monetary policies drove precious metals to new heights. One of the clearest examples is the aftermath of the 2008 financial crisis. As global markets crumbled and central banks slashed interest rates, gold surged from around $800 to over $1,200 per ounce in just a year. Silver followed a similar trajectory, climbing from $11 to nearly $20 per ounce. The catalyst: a combination of quantitative easing, lower interest rates, and a loss of confidence in traditional financial systems. Fast forward to 2019, a year marked by the Federal Reserve's pivot from tightening to easing monetary policy. By mid-year, rate cuts were in full swing and precious metals took off. Gold rose nearly 19%, while silver posted gains of over 30% by the end of 2020. The lesson here: when central banks flood the system with liquidity and weaken the dollar, precious metals thrive. Now consider where we stand in 2025. The economic setup is eerily similar to these historical precedents. The U.S. yield curve has just reverted after 2 years of inversion, a reliable indicator of an impending recession. Federal Reserve policies are expected to shift toward more aggressive rate cuts, and central banks are hoarding gold at near record levels. These are the exact conditions that have historically propelled gold and silver to unprecedented highs. But here's the kicker. This time, the stakes are even higher. Unlike past cycles, today's global economy is grappling with unprecedented debt levels and geopolitical uncertainties. The U.S. national debt has ballooned to $37 trillion, and the dollar's dominance as the world's reserve currency is increasingly under scrutiny. Add to this the surging industrial demand for silver, and you have a scenario that could make 2025 one of the most explosive years for precious metals. There's a saying, history is the best teacher. So what can we learn from these patterns? Will gold and silver follow the same upward trajectory as they did in 2008 and 2019? Or will new variables like central bank demand and green energy trends rewrite the script? We'd love to hear your perspective. Do you think history is about to repeat itself? Or are we heading into uncharted territory for precious metals? Let us know in the comments. And don't forget to subscribe for the next step in uncovering the 2025 outlook for gold and silver.
Well, if anything, I try to do my part by, adding inventory for people to read. And I think that's how, people that are watching us right now should look at it. Michael Oliver does a great job. They should subscribe to his service and get his newsletter. I know Christopher Mullen. A lot of guys like me that share their opinion, and we all kind of have our niche area in a way. And so I would encourage, this is kind of the same caveat I tell people every year: find independent, objective sources of information, and then take it all in and digest it, and then think for yourself and discern from there where you think things are headed. We all kind of see it going into the same place, but from different angles. And so maybe that's helps people kind of see the light a little bit. A lot of the market concern is a liquidity issue, and I wrote about this in last year's Macrocast. I wrote it again this year. There used to be $2.5 trillion parked at the Fed in their reverse repo fund, which is like excess reserves, is what, the Fed pays interest on the excess reserves. Well, they didn't want that money further messing with the yield curve and everything else. And so the money was just kind of held there in 2023, and it actually got going in 2022. Well, Janet Yellen then decides that for the funding purposes of the federal government, she's going to issue a whole bunch of treasury bills and soak that money up. You get that money out of that reverse repo and get it out into the economy, get it into the bond market. And then from there, it's loose and it can go into stocks and provide liquidity for everything. Well, that reverse repo account now is down about 90%. Okay, so where's that added liquidity going to come from? And I think that's all that's a part of the piece of the puzzle for this year. Because again, at the end of the day, the Fed talks a good game. Powell likes to make himself seem like a man of the people, and we're worried about inflation, all this kind of stuff. But a choice will be made. His back, or whoever the head of the Fed will be, their back is going to be against the wall. And they're going to have to decide between, well, we're going to kind of toe the line with austerity, and not provide the funding for the government and all of the debt and the deficit and everything else. And it's just see what happens. We're going to try to get inflation down for the average guy. Or we're going to say, well, you know what? Everybody benefits from keeping this scheme going, from funding the $2 trillion a year in deficits, from making sure there's liquidity for the capital markets and everything else. So
now, let's talk numbers. Experts and analysts have been crunching the data, and their price predictions for gold and silver in 2025 are nothing short of remarkable. If these forecasts hold true, this could be a record-breaking year for both metals. So what are we looking at? Let's start with gold. Goldman Sachs, a leading voice in the financial world, has projected that gold could reach $3,000 per ounce by the end of 2025. Other experts, like Hemke, are even more bullish, suggesting that prices could climb to $3,100 or $3,150 under the right conditions. What's driving these lofty numbers? It's a combination of factors we've already discussed: central bank demand, anticipated Federal Reserve rate cuts, and a weakening dollar. These elements create a perfect storm that could propel gold prices to all-time highs. Now let's turn to silver, the metal that many believe will outperform gold in 2025. Analysts predict that silver could rise to as much as $56 per ounce, with more conservative estimates hovering around $36 to $40. Unlike gold, silver has the added advantage of surging industrial demand, particularly from the renewable energy sector. Solar panels alone could account for a significant portion of silver consumption in the coming year, adding to its already strong investment appeal. But here's what's truly fascinating. Silver is currently undervalued compared to gold. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, remains historically high. As silver prices catch up, we could see a dramatic narrowing of this gap, amplifying returns for investors who get in early. These predictions aren't just speculative. They're grounded in hard data and historical trends. Take 2024 as an example. Gold rose by 25% that year, while silver climbed over 20%. Many analysts believe these gains were just the beginning, setting the stage for even greater growth in 2025. Of course, no forecast is without risks. Price targets depend on numerous factors, including the pace of Fed rate cuts, the trajectory of inflation, and resilience of the global economy. But the consensus among experts is clear. If you're looking for assets with high potential in 2025, gold and silver are hard to beat. So, here's the question. If gold hits $3,100 and silver climbs to $50, how would that change your investment strategy? Let us know your thoughts in the comments. And don't forget to subscribe for more expert insights into the future of precious metals.
I was dead wrong last year about that. I thought, again, we'd probably go sideways for the first 6 months of the year. We went sideways only for the first 2 months of the year. I thought price would take off by July. Price took off in March. And then so it got way ahead of itself. I thought we'd get to maybe 2,300, 2,350. And instead we got to 2,800 and finished the year, as you said, up 25%. So now you look back historically and you try to see, okay, what has happened in previous years after that big of a rally? Typically another rally follows, but not as much as that last one. So anything's on the table. The world is so crazy these days. And if the Fed, what if by the end of the year, Elijah, what if inflation is raging, but the economy is in the toilet, and by the December FOMC meeting, the Fed is talking about yield curve control and renewed QE to try to keep the long end down to finance the government. Who knows what the world's going to look like 10 or 11 months from now. And if that's the case, gold could be 3,500, 4,000. But I think knowing what we know, given the knowns at this point, at least as I think there are knowns, the next move should take us about 10% higher past the old all-time high. That's typically how it unfolds. You can see that price kind of unfolding that way as we move through 2024. So maybe that takes up to 3,100, 3,150 at some point later this year. And then, maybe continue to pull back and kind of wait and see from there. Maybe finish the year higher than that, maybe finish the year a little bit lower than that. But again, for precious metal stackers, that would be a pretty good year. We all get kind of caught up sometimes in the mining shares and what that does to sentiment of everybody because, GDX was up 8% last year. I thought they were supposed to outperform the metals. But for the metals themselves, they're doing just fine. And I would suspect they'll do just fine.
While the outlook for gold and silver in 2025 is undeniably exciting, no investment story is without its challenges. To make informed decisions, it's crucial to understand the potential risks that could temper the optimism surrounding precious metals. One major concern is profit-taking behavior. After a strong run in 2024, some investors may decide to cash in on their gains, especially if gold and silver prices approach their predicted highs. This could lead to short-term price corrections, creating volatility in the market. For instance, during past rallies, we've seen sharp pullbacks when prices hit psychological resistance levels, such as $3,000 for gold or $40 for silver. Another challenge is the global economic environment. While a recession seems likely based on historical indicators like the yield curve reversion, there's always the possibility that the economy could stabilize or even grow against expectations. If the Federal Reserve delays or minimizes its rate cuts, it could reduce the appeal of gold and silver as safe haven assets. A stronger than expected dollar, bolstered by economic resilience, could also put downward pressure on precious metals. Geopolitical events could further complicate the picture. While conflicts and uncertainties often drive demand for safe haven assets, resolution of major disputes, like the situation in Ukraine or trade tensions with China, could shift investor sentiment away from precious metals and back toward equities or other asset classes. On the industrial side, silver faces unique supply and demand risks. While demand for green technologies is expected to remain strong, disruptions in supply chains or changes in technology could impact silver's industrial applications. Similarly, any slowdown in the renewable energy sector could temper silver's momentum. Finally, we have the role of market manipulation. Historically, silver has been one of the most heavily shorted commodities. Large institutional players, such as bullion banks, have occasionally suppressed prices to protect their short positions. While this doesn't negate silver's long-term potential, it's a factor that could create frustrating short-term volatility for investors. So where does this leave us? Challenges and risks are an inherent part of any investment strategy, but they also create opportunities. For long-term investors, price dips caused by profit-taking or volatility can present excellent buying opportunities. And for those who stay informed, understanding these risks allows for more strategic decision-making. What's your take on these challenges? Are they enough to deter you from investing in gold and silver? Or do you see them as opportunities in disguise? Let us know your thoughts in the comments. And don't forget to subscribe to stay updated on the ever-changing precious metals market.
These things in December, and I start compiling charts that I think get an idea of the direction I think I'm going. then I know, gosh, for my adult ADHD to sit down and actually pour energy, 4 hours at a time, 5 hours at a time into writing the thing is exhausting. And for what, right? I mean, the things I get right, people are like, well, anybody could have seen that coming. And the stuff I get wrong, everybody's like, oh, what an idiot this guy is. He actually thought, and so that is why I do it, so that I can, because invariably I'm going to get stuff wrong and I want to know why I got it wrong. I want to be able to go back and look and try to discern, what I was thinking at the time and why I got it wrong if I can. And so when I look back at last year, we entered last year, everybody was all hyped up. The markets were thinking 6 or 7 rate cuts. And the Fed was saying, no, maybe more like 3. So I figured there'd be this kind of a tough period before the Fed actually started cutting. I thought they'd do it by July. They did it in September. I thought that would be the driver. Looking back, though, now that wasn't the case. The driver seems to have been central bank demand as the main thing that underpinned the derivative price. These big positions get built up on COMEX for both the speculators and the banks, but we never had that big washout. We had these periods of consolidation, but we never really got shoved backward. And I think that central bank demand underpins the price, and it seems to be continuing. China stepped back up after allegedly taking 6 months off, with 5 metric tons in November, then 10 in December. So if this trend of central bank demand, physical demand, underpinning the price, buying all the dips, that should help promote a good year this year. So we're back to watching the Fed, see what they will do. I called the thing inversion reversion because I think the key indicator is the yield curve, which had been inverted for 2.5 years, but now it's reverted back to an upwardly positive sloping curve where the 10-year yield is higher than the 2-year. And that's historically when the recession actually begins. The inversion predicts a recession is coming. But if you look at the charts that the Fed puts out, the last 6 or 7 recessions have followed that inversion reversion. And that's what's now happened. The 10-year note's about 40 basis points higher than the 2-year note. So I'm basing this whole forecast on the fact that the Fed is going to be wrong. Economy's not as strong as they think it is. They're going to be cutting more than just the 50 basis points they're expecting. That combined with this ongoing central bank demand and what else is coming at us this year, Elijah, I think makes for a pretty strong year for the precious metals.
So where does all this lead us? Let's connect the dots and answer the big question. Why are gold and silver poised to soar in 2025? First, consider the foundation. Central banks are buying gold at near record levels, driven by a desire to diversify away from the weakening U.S. dollar. This demand creates a floor under gold prices, preventing significant drops and setting the stage for steady growth. Add in silver's dual role as a safe haven asset and a critical component in green technologies, and the case for both metals becomes even stronger. Then look at the Federal Reserve. The anticipated rate cuts of 50 basis points might just be the beginning. With the U.S. economy showing signs of strain and a yield curve signaling an impending recession, deeper cuts are not just possible, but likely. These actions will further weaken the dollar, amplify inflationary concerns, and funnel more investors into gold and silver as hedges against economic instability. The U.S. fiscal situation only strengthens the argument. A national debt exceeding $37 trillion, coupled with skyrocketing deficits, paints a picture of long-term economic vulnerability. Historically, when confidence in fiat currencies wanes, gold and silver have been the ultimate safe havens. Now add silver's unique industrial demand into the mix. The renewable energy revolution is not slowing down, and silver is critical for technologies like solar panels and electric vehicles. With supply chains already strained and above-ground silver inventories depleting, it's hard to see a scenario where silver doesn't experience significant price growth. But let's not ignore the risks. Yes, profit-taking, market manipulation, or unexpected economic resilience could create turbulence. Yet for long-term investors, these challenges represent opportunities to buy on dips and secure positions before the next rally. So where could this all lead? Analysts predict gold could surpass $3,100 per ounce, while silver might climb to $40, $50, or even higher by the end of the year. These aren't just numbers. They reflect the perfect storm of monetary policy shifts, economic vulnerabilities, and industrial trends that make 2025 a potentially historic year for precious metals. Let me leave you with this. What role do gold and silver play in your portfolio? Are you prepared to capitalize on what could be one of the most explosive years for precious metals in recent history? Share your thoughts in the comments. Hit that subscribe button, and remember, this is not financial advice, just the facts and insights you need to make your own informed decisions.